Now the third scenario is one of the more common scenarios. Company's been around for a while. They say to you, you know, I went into a bank and the bank said that they need some reports. I've never seen it. I mean, they called it a balance report or balance paper or something like that. I can't remember. And a P and R, P and S. Do you know what they're talking about? P and L? Oh, yes, that's what it was. It was a P and L. Can you help me on that? Now, the tendency by some accountants is to say, yes, I'd love to help you with that. Why don't you bring down all of your checks and all your deposits and sales invoices since you started the business? Bring them on down to my office. And the next thing you see is you see that panel truck backing up, okay? And boxes and boxes, and they fill up your family room, and then they start moving into your bedroom, and then they start getting into your basement, and you just, well, the stacks and stacks, and you look into it, and most of it has nothing to do with what you want. But even if you did want to take the week or two to go through all that stuff, and then you start entering transactions from 3 years ago, what do you think is going to happen? It's going to be crazy. And you're not going to remember, or they're not going to remember half of the transactions that went on. And secondly, what do they care about what happened 2 years ago? What do they want to know? Right now. They want to know what's the situation right now. And that's what the bank needs to know. And so that's the long way and the wrong way to do it. Your purpose is to come up with the numbers currently, okay? And you can do that in a matter of minutes or hours if you approach it the right way. So we're going to go through that process right now. If you'll turn to page 2.3, in fact, it's just facing the page you're probably looking at right now. About a third of the way down the page, you'll see a list of 5 items. These are items that you will want the small business owner to have available when you meet together with that person in their office. When you go into this meeting, you need to be prepared. Okay? You don't want to just go into it blindly. You need to go in there with a list of the accounts that you think this company might need. Okay? Now the process is the same as the previous scenario that we dealt with. You've got 3 resources. You're going to sit down and try to analyze, based on a little bit you might know of this company, what type of assets and liabilities and sales and costs and expense accounts that they'll need. So you're going to try to create that. Now we're going to do that real quickly for just a minute. We're going to somewhat simplify it. But let's imagine that we are setting up books for a, what kind of store? What kind of business? Anyone got an idea for a business? How about a bicycle repair shop? Should we do it for that? Yeah, why not? You know, it works, okay? They repair bicycles, and so we're going to look at what type of asset accounts do you think a bicycle repair shop would need? What are they? Just name one. Okay, petty cash, okay? So we're going to set up a report. Petty cash will be the first item. What else? They'll need a bank account, okay? Okay? Accounts receivable. Why would a bike shop maybe need an accounts receivable? Okay, so they might have some customers that come in on a regular basis, maybe, you know, racing team. Good. That's a good example. So yeah, they might be able to give them credit. Okay. So accounts receivable. What else? Might have cash on hand. Okay. Inventory of parts. Right. Okay. Let's not make this too complicated, just because otherwise we'll be here for a long time. How about equipment, fixed assets? What will they need? They might have shelving or a desk and so forth. So we might have furniture. How about equipment? Will they have repair equipment? Yeah, so we'll call it equipment. That sounds like a good list to me. Okay. How about liabilities? What will they have? Accounts payable. Maybe they got a business loan for getting all the parts initially and the equipment, so we'll just call that a bank loan. Now, of course, if they had employees, all of a sudden we got a whole bunch of them to work in there, don't we? Okay. Will they charge sales tax? Probably. Yeah. It depends upon the state, of course, but probably in most cases they're going to charge sales tax. So there's a list of liabilities. Now, if I tell you that this is, we need the accrual accounts, don't we? Okay. What accrual accounts do we have? Okay. So we've got accumulated depreciation for furniture and accumulated depreciation for equipment. Okay? And if I tell you this is a proprietorship, what accounts will we need for the capital section? Owner's draw, owner's investment or equity, and earnings, right? Okay? Now, that wasn't that difficult, was it? That's the first step, just coming up with those accounts. Okay? Now, I'm not writing those accounts down here because there's a special account that we're going to use for just a month or two that we're going to set up in its place, okay, for now. And we'll correct it later. Okay, now, once we have this is our list that we're going to go into the business owner with, this meeting. And we're going to use those 5 resources that we asked them to have with them to create the balances as of the last day of the previous month. Okay? So if we were doing that today, we would be doing it for July 31st, as of July 31st. Notice we're not going back to January or February or March. We're not worrying about those. We're coming up with the balance as of the last day of the previous month. Okay? And we're going to ask him questions. We're trying to extract from his mind the balances here. If he'd had a previous accountant, we could have looked at their numbers, but he didn't have a previous accountant, so we're going to use the best information we have available. Now, so we say, how much petty cash do you have? And he says, petty cash? Petty cash is always important to me. It's never petty, okay? So what do you have to tell him? What a petty cash is. You got to describe it. What is petty cash? It's money that we're not going to deposit, okay? Do you have any cash that sits around here in a metal box that you're just going to use for small little incidental purchases? He says, my only petty cash is in my back pocket, okay? So what's the balance in petty cash? 0. Well, we didn't know it was 0 until we talked to him, so it's all right. We'll just delete that account unless he wants to start a petty cash account later on. Bank account. What's our best source? What's better than the bank statement? Check register. Yeah, if he keeps a check register. Yeah. Very often you'll find small business owners kind of run by the seat of their pants, and their only balance that they follow is whatever the bank told them when they pushed that button on their phone that had the automated voice that said what was in their account. Certainly, if that's the only one that you got, then the bank statement's your best source. Okay? However, if they do keep a check register and it is fairly kept current, then we would use a check register. Now, if he says, I've got $2,500 in my bank account, we're going to write that in. We do not have to say, prove it. Okay? I don't believe you. Okay? You wouldn't have $2,500. You don't say that. You just take it. Why? These reports are his responsibility, not yours. Okay? If he says there's $2,500 in the account, he's the one that's signing that number's correct, not you. If you were a CPA performing an independent audit, it would be a different story, but you're not. Okay? You're providing a service to him, and if he says $2,500, that's the balance that's in there. Okay? Now, another thing we said is give me a list of all the receivables, correct? If he did his homework and he's got a list of the receivables, and maybe it is that bicycle racing company, that's that receivable, and it's only one customer and they have a balance of $1,500, what are we going to put here? Now, if he just says, I have no idea, a whole bunch of people owe me money, I don't know who they are, I don't know how much it is. If that's the answer he gives you, what do you put down here? 0, okay? Because if that's all he knows, nobody owes him any money. And I can tell you, I've had a painter friend that I worked with a little bit. I can tell you right now, he gave me that answer. He says, "Oh, I don't know, a lot of people owe me money." And if once I understood his system, I can tell you why. He never wrote anything down. Okay, he would give a bid to the person. It was just right off his head. He would say, "I'll do it for $4,000. I need 10% down." They'd give him a check for $400. 2 weeks later, he'd go in and say, "I need some more money." They'd give him that money. 3 weeks later, he'd go in and get some more money. He never wrote any of this down, didn't know where it was from. At the end of the job, he couldn't remember how much he'd bid. He couldn't remember how much he'd gotten. So all he did was just kind of put his hand out and say, "Please." Okay? And when they gave him less than that he thought he should have had, he knew that they were lying to him, or he thought they were anyway, and so he figured they owed him money. But what are the chances he's ever going to collect it? It's not going to happen. So 0 was the answer in his case. Okay? But in this case, we had a company name, we had an amount, so we were happy with it. Okay, cash on hand. What's the balance going to be in cash on hand if we make a deposit every night? 0. So we're just going to assume 0 right there. Inventory. He has all these little parts and little items that he sells and so forth. We ask him to tell us how much it's worth. Okay? And he's probably going to pull it right out of here. Okay? It's probably what's going to happen, because the likelihood that he took a physical inventory on July 31st without being asked is what? It didn't happen. Okay? I can tell you it did not happen. So we asked him, "What do you think all those parts, those nuts and bolts and the chains and the pedals and everything, tires, and what do you think it's worth?" And he says, $500. Okay? So what are we going to write down if that's what he says? $500. Okay? Furniture. We need to know 3 things about every fixed asset. We need to know a description. Okay? General description. We need to know an estimate of the original cost, and we need to know approximately when it was last purchased. Okay? Now, if we say, "Okay, now you've got some desks around here. How much did they cost you?" And he says, "Oh, I bought them for $25 at a garage sale." How much are we going to put in the furniture and fixtures account? Why not? Why 0? It's not material in value. It costs less than $500 for each item, so we're going to put 0 down there. We won't even list furniture as one of our accounts when we go back, okay? But then we say, "What about equipment?" He says, "Well, I got this grinder here, paid $600 for it." So what are we going to write? We're going to create a list of this equipment. And we add up and we write down that it's a certain kind of grinder, and he says it costs $600. We say, "When did you buy it?" He says, "Oh, a couple years ago." Well, what's a couple years ago? 2 years ago. That's what it is. 2 years ago this month is when it was. Well, you say, "Do you have to prove it?" No, you don't have to prove it. Okay? You just write down. You subtract 2 years off the current year and you write down the current month. Why do we do that? Because it makes it a whole lot easier to calculate depreciation. Okay? Do you need to say, "Can you show me an invoice?" No. Because all we need to do is show the cost, and it can be an estimate, and show the approximate date of purchase. Okay, so make it easier on yourself. Use the month 2 years earlier and calculate depreciation. So if that was the only fixed asset he had, was that grinder, everything else cost less than $500, then we got a $600 item right there. Okay, let me ask you this. Is there a chance any of these numbers are wrong? Well, I'll tell you, almost every one of them is wrong, okay? The only thing we know about a number when it's estimated is what? It's wrong, okay? We know it's wrong. We hope it's in the ballpark, but we know it's wrong. And remember the issue of materiality. Remember us talking about that? If it's close in the ballpark, we're probably going to be all right, legally and for business purposes in this. Okay, so we add up all of our assets now. What do our assets come to? $4,500, right? $5,100. So what does this side have to add up to? $5,100. Let's go through it. Accounts payable. How are we going to figure that out? We asked them for a list of payables, right? Okay, who he owes money to. By the way, this one they tend to understate. I will tell you that right now, okay? They tend to forget some of these, but we're going to go with whatever their list says. So we're going to ask him for an actual list. Well, he owes his landlord, this much, and he owes supplier this much and so forth. And some of them might be current, some of them might be past due, but we just want the total, and so the total adds up to $1,700. We've got the vendor's name, we know the amount, that's all we needed, okay, to create our subsidiary ledger and to create the balance in the general ledger. So we ask him, how much do you owe the bank, okay? And he says, oh, I think it's probably about $3,000 right now, okay? How much do you owe in sales tax? Ah, the foggiest, okay? I don't know how much I owe in sales tax. Well, what can we do? We're going to do it as of the end of July, right? So there's 1 month into the third quarter. How can we approach sales tax? Ask for the total sales in July. If he says total sales were $2,000 and a 6% sales tax, that's what, $120? Okay? So that was pretty simple, wasn't it? We could do it that way, or we could ask him each quarter on average, how much do you pay in sales tax for an average quarter? And he says, oh, I don't know, $600 a quarter on average. So could we then estimate what a monthly sales tax is? And certainly, of course, during the summer in this business, since we chose a highly seasonal business, at least in this area, in Utah, that's a seasonal business. Now, if this were San Diego or Arizona, it may not be as seasonal, but here it is, okay? Then we'd want to consider the seasonality. But if he says, oh, it's, we calculate that it's about $200, that's what we're going to write down there. It's an approximation, but close enough for our purposes, right? Okay? Now, accumulated depreciation furniture, we know that's zero because there was no fixed asset balance in furniture. However, this one, that's 2 years old. It's equipment, okay? So could we calculate the depreciation for it? How would we do that? Look in the chart in the book, right, okay? Now, grinders. They're right in between electronic equipment and equipment. I would have to look in the book myself, but I think probably about a 5-year life for a grinder is my guess, okay? I could be wrong, but let's imagine that it is 5-year life. So that means each year we're going to depreciate 1/5 of $600. How much is that? Anybody know? $120 a year. We've had it how many years? 2 years. So what's our accumulated depreciation? $240. Okay? That's why we like to keep it in a nice, even number of years. See how easy that was to come up with that. Now, in the future, we're going to continue to depreciate it. Okay? And we're going to depreciate it at about $10 a month, aren't we? Okay? And so if it's that little amount, we might choose to just depreciate it once a year if it's only that small amount. But we could do it $10 a month. Okay? Now, this means that we have here $4,900, $5,140, right? If we add that in. How much do we have on this side? So what does that mean our capital balance has to be? Minus 40. Do you think any companies ever run with the minus number in their capital section? Oh, some people like to make a habit of that, okay? So we have minus 40. Now, how do we know that? Because this side has to add to that side. And so we have $5,100, okay? Now, we're going to apply that balance to an account we haven't dealt with before. It's called prior period adjustments. Prior period adjustments, okay? This is a temporary account. It's an account only created until we know that we've refined these numbers to be accurate. We recognize that minus 40 in the capital section may or may not be accurate, depending upon the accuracy of the others. For instance, let's imagine that we get a check in the mail from another customer, and it relates to sales from 3 months ago. Maybe $300, okay? Wasn't listed as one of our customers on accounts receivable, but should it have been? Yes. So we call the owner. We say, hey, listen, there's got this check in here from this other event, this other customer. And the owner says, oh, I forgot all about that. Yeah, they owed us that $300, okay? So what does that mean? That means that this number was wrong, wasn't it? Should have been $2,800 had we known it was correct, the correct number. So if this number's wrong, which number over there is wrong? Prior period adjustments, because it was our force number, wasn't it? So we're going to make an entry into the books. During the month of August, we're going to make an entry debiting accounts receivable, debiting accounts receivable here, and crediting prior period adjustment, $300. Does that make sense? Okay. Now, the other customer paid us. Everything looks fine. So we feel pretty good about accounts receivable by that time. We look at the bank account. It said $2,500 was in the bank account. We go back and reconcile the bank account at the end of the August, and we find out we started out with a bad number. It was off by $150. Actually, we should have had $2,350 in here instead of $2,500. He hadn't taken off all of his charges from past months. Okay? So if this number's wrong, which number's wrong over there? Prior period adjustment. So we're going to make an entry. What do you think that entry for $150 is going to look like? What are we going to debit? What are we going to credit?
Credit bank.
Credit the bank? Debit prior period adjustments. Exactly. Okay? Now as we go down these accounts and audit each one, we're going to check them off. We're going to say, yeah, based on the end of August, these are right. And we're going to adjust any ones that are wrong through this prior period adjustment account. And we might find out that it's actually a credit balance instead of a debit balance. Just here it turned out to be a debit. We go down, the inventory, we ask them to take a physical count at the end of August so we can get a real solid number in that inventory number, and we might find out that this number was way off. We'll adjust it. So then we check that off. We check off the equipment because we didn't find any other equipment. All the vendors' bills come through just like the report. That never happens that way. You get vendor bills that he didn't list in there, and so you go in and you adjust accounts payable. If the accounts payable is wrong, if that should have been $2,000, which other number's wrong? Prior period adjustment. So what are we going to do? If it applied to prior to July, we're going to credit accounts payable. We're going to debit prior period adjustment. Okay? So on and so on down through this process. And at the end of the August then, you will be able to go through each account and prove its accuracy, adjust it through prior period adjustments. Once you know all the assets and liabilities are right, what do you know about capital? It's correct. And once you get to that point, you change prior period adjustments to owner's equity, and you're off and running. Do you follow that? In the meantime, during the month of August, you have been entering in all the August transactions, just like you normally would. And so at the end of the August, you will have a August correct number. Now, in the meantime, if he needed those statements for the bank, okay, you have prepared a balance sheet for him to take into the bank. Don't put your name down at the bottom saying proven by or something like that. Certainly don't say audited by. Simply provide that form to him. You can put unaudited down at the bottom if you really want to make sure it's understood this is not an audited financial statement. Put unaudited down there. Don't put your name on there because you haven't proven the accuracy of any of these numbers. But it's what the bank wanted. They just wanted to have a close approximation of the financial position of that company. Okay? Does that make sense? Could all of you do it? That's the process we use. Okay? And this would be the case whether the company, if the company has never had an accountant before and you've got to come into the business and get those financials created, or if the company, you went through and audited the financials, you were getting them from a previous accountant and the numbers were worthless, they didn't even come close to reality, you would go through this process in getting the books together. Okay? This has all sorts of advantages, but one thing that people oftentimes ask me is, well, what about tax returns? Don't they need to know the sales, costs, and expenses for January through July? They do, don't they? Okay? But remember, that's the tax preparer's job. That's not why they're hiring you. They're hiring you beginning with August 1st forward. You just had to have the balance sheets to begin with. Secondly, a good tax preparer can take 3 or 4 months of P&L data, profit and loss data, and actually create 12 months of data. So they might never have to go back into history to come up with those numbers. They might be able to come up with them just off of what you give them for the future months. Okay? If they want you to go back and create history, can you do that? At a cost, certainly. But the other thing I want to point out is do that in the future as time permits. But get started with some numbers you can start using right now. Otherwise, you will always be behind, won't you? Okay? So go ahead and use the numbers now. Get started. Do your regular current accounting. And then as time permits, at a cost, you can go back into pre-July 31st and start gathering that data together because they might want it for operational purposes. Okay? Questions about that? Okay. Very good. Did you learn something tonight? Yeah. Hey, I love this stuff. I love this stuff.